Yeah, that's the other flip side of it. You say, well, okay, I have unlimited time, I have unlimited budget in some paranormal universe, if that was the key. Well, here's the other problem with planning off of every item on the menu. As a small business, you don't have enough data points.
I can see the whole wide world with these two eyes, and I can be whoever I wanna be, 'cause it's my life.
Hi, thanks for joining us for another episode of Ask Spurrell CPA. Today we're talking about the business plan, executive summary, gross margin subsection. So here at Edmonton CPA, Spurrell and Associates, we're talking about the business plan, executive summary, gross margin. I have Cole here with me again. And Cole, you've helped us, assemble a couple of those gross margin sections on the business plan, helping them simplify that, right?
Yep.
So that's a bit of a process to go through. One of the questions, the quote that we have here, the famous Benjamin Franklin quote on planning: if you fail to plan, by default you are planning to fail. So if you fail to plan, by default you are planning to fail. Palo Alto has shown this. They've done the research and they've surveyed the business owners regarding business plan, and they found that business owners who complete a business plan are 50% more likely to grow their business. And the story that we have here is, business plans, they're looking for financing. They're looking for improve the profitability of their business, but they don't understand the profitability of their business on the most basic per transaction basis. They need to understand the profitability of their business on a per transaction basis. So Cole, what are the questions that these business owners should be asking?
Well, first they should be asking, what is the executive summary of a business plan?
So the executive summary is the first section of the business plan. It has the most pertinent information summarized in one section. And it's, often the only part that some investors or bankers, that might be the only thing they actually ever read of it. So it better be on point. And also, as a business owner, if you have the most pertinent information in the executive summary, it makes it easy to refer to it during the year when things are busy. You don't have to go through the whole document. Sometimes you don't have time to go through the whole document, but you might have time to go through the most important stuff right at the beginning. And that's the stuff in the executive summary of the business plan, and it's the first section of the plan.
What is the difference between gross revenue, net income, and gross margin?
Yeah, so we have gross revenue. That's what you charge a customer before any expenses at all are paid. These are the revenue that you earn before any expenses. That is gross revenue. Net income is what we made after all of the expenses, both the direct expenses and the overhead expenses. And then we get to gross margin, where we take the revenue and just the direct cost of sales. So if you're a contractor, it's just the cost of the sub trades and the materials on the job. You're a doctor, it's just the cost of the associate doctors. So before any of the overhead expenses in there, you have the rent and the administrative staff and the insurance and the accountant and all of those other overhead type expenses. What do we make after we pay just those direct costs of the sales, which usually vary? We usually have more of them if we sell more, and less of them if we sell less, whereas the overhead expenses tend to be a little bit more stagnant.
Should you have a gross margin analysis in the executive summary?
100%. I think it's so fundamental to the profitability of the business, to understanding where you're taking the business. If you want to grow the business, you have to grow the business on a per transaction basis. That sort of gross margin analysis, and going, even a step further on a per transaction basis. What does that gross margin analysis look like? It belongs in the executive summary. It's at the top of the list of what's important.
Do you do a gross margin on every price point, or do you average similar items?
So I don't believe in doing a gross margin on every single price point. You could have a medical doctor and they can bill the client for $20, and they can bill the client for $20,000. I'm not going to do a gross margin analysis on every item on the menu, so to speak. We're going to aggregate similar types of transactions and do planning on that. I find it a little more reliable.
How many items or transaction types do you normally consider in the plan?
I'll normally boil most businesses down to no more than three types of transaction types. You could do more. Like I said, people have different pricing. You know, they got a small job that looks like this and a big job that looks like that, and medium, and all the way up the line, and they have, you know, different products, services, items on the menu. But let's start grouping similar items. So, like, for example, if you're a contractor, this is what your project work looks like. Every time you go out and bid a job, on average, it's about this. And, you know, then you have your service calls. When you send out a service technician, it's, you know, you're charging this much an hour. They're billed. If you try to group those two together, it can be a little bit confusing, and often there's different profit margins on them. But you can generally boil transaction types into one stream, and I'll normally go to no more than 3 usually.
Is it efficient to consider more than 3 transaction types in the plan?
I don't think so. I think it's going to be a lot of unnecessary data crunching. So I think you're going to spend a lot of time and potentially money and energy trying to really get, you know, what is my small, what is my sort of small, what is my medium, what is my somewhat medium, and just have all these different revenue streams coming in, and you have to do the calculation to get the historical value, and then you have to do more calculations on each one of those streams to get the aggregate value. It's costly. I don't think it's efficient. Even if cost was an unlimited factor, remember, you only have 168 hours in a week. Is that what you want to be planning on? I don't know if it's the best benefit of the business plan.
Do small businesses have enough data points to consider more transaction types?
Yeah, that's the other flip side of it. You say, well, okay, I have unlimited time, I have unlimited budget in some paranormal universe, if that was the key. Well, here's the other problem with planning off of every item on the menu. As a small business, you don't have enough data points. Let me explain. Is if you're McDonald's and you want to know how much you're ordering on French fries, you're selling millions of orders of French fries every year. If you're a small restaurant and you want to figure out how much you're making out on onion rings, even if you got the price points for the oil and separated it from the other oil that you use from the other products, and you drove yourself nuts in getting that, you don't have enough data points that those number of onion rings are going to be sold next year. You only have one restaurant. You only sold so many orders of onion rings. There's no guarantee that, because the sample size isn't big enough, there's no guarantee that sample size will repeat in the future. But if you knew something more relevant, like how much you make every time someone comes and sits, a person comes and sits down at your table, that's a really powerful number. But knowing how much you make on onion rings, it's a costly number to get to, and even if you know it, it probably doesn't have a lot of predictive value for most small businesses because there's not a lot of data points.
What would the gross margin analysis look like in a tradesman's business plan? Yeah,
so a lot of tradesmen, we do a lot of trades guys here, and a lot of times they have project work. They have work that they go out, they do an estimate for, and maybe that estimate sometimes is $1,000, and sometimes they do an estimate and it's $250,000 to do a renovation. But at the end of the day, they're going to get an average in that project work, the type, the niche that they're going for based on their skill set, who they are, what their credentials are. They're going to get to an average transaction size. And then from that transaction size, they're going to have the price that they charge on that project work. They're going to have their costs. And the costs are generally going to be the sub-trades, the material cost, and the cost of the self-performed work, or the labor costs, the actual guys that they have, that they employ, that are working on the site, not the ones that are working in the office. And then you're going to have your gross margin on that. So my average project size is this. I spend this much to actually produce it, and this is what's left over before I pay any overhead expenses. And then a trades guy, it might be highly relevant. Like I said, they usually have projects and they'll have service work, and lots of times the margins are drastically different from the projects and service work. So we might have project work as revenue stream 1 and service work as revenue stream 2, and that's what their gross margin analysis is going to look like for a trades guy.
Okay. What would the gross margin analysis look like in a doctor's business plan?
It can be really simple in a doctor. Even though doctors have a million procedures, they went to school forever and what they can do, at the end of the day, every time a patient walks through the door, they get to an average of, this is what it is. And it's amazing when you go back year to year to year, that average is very, very similar and very, very predictive. But like I said, how many procedures of this type they did in 1 year has nothing to do that they'll do that type of procedure in the next year. It often has a low predictive value, but their average transaction size tends to be really predictive of what's going to happen in the future, and it's a very powerful number. So they might just have, what is the cost for an average patient visit? What do they pay the associate doctor? What's their cut of that revenue stream, and what's left over after that? That's usually what it looks like.
How does this average transaction size help to determine a marketing budget?
There's the key. This average transaction size is so powerful. If you had the number of what you make on onion rings, so are you going to go run ads for people to come buy onion rings in your restaurant? No, you're going to go run ads on how to bring people into the restaurant, how to put butts in the chairs, right? And if you know how much you make every time you put someone into that chair after they pay their bill and you pay the food costs and you get the meal out to them, now you know what you can actually afford to pay to get someone to come into your restaurant. If you're a contractor, if you want the phone to ring for a service call, if you know on average how much that service call is and what you're going to have to pay the guy to go do it and what's left over, you know how much you can spend to make that phone ring again. But if you try to do that on every pricing level and every item on the menu, you're actually not going to have enough. You'll have the wrong type of data to actually determine how much you can expend to acquire one more customer, and that's usually a number that we want to get to. So I think that's what we have here today on the business plan, executive summary, gross margin part of the executive summary. As always, we look forward to seeing any comments below so we can respond back to you guys and use your comments to guide us on what future videos to do. And as always, please hit the like and subscribe button so we can continue to deliver you tips on how to beat the odds at business. Thanks very much.